right here in our studios. Nilesh, good afternoon. Good to have you on the show. You're running a lot of money, 1 lakh crores, right? But look, Nimesh spoke about some mind-boggling numbers, but you've been talking about it. We've seen some of that play out over the last 1 year. Can we extrapolate this data now over the next 5 years?
So when I started my career many years back, I met a veteran of mutual fund industry. And he said mutual fund will be like bamboo tree. You keep on working hard for 5 years, nothing will materialize. And 6th year, you will see a tree which will grow 30 meters in height. There will be always a hockey stick in mutual fund AUM. Keep on working, don't lose patience. Keep on ensuring that your platform continues to remain solid. And I was wondering, like, is this old gentleman telling me the truth, or he's just trying to retain me? He's just trying to motivate me. But I know now his wisdom. I mean, clearly last 2 years have been fantastic for mutual fund. Whatever we had dreamt of, the reality is far better than that. And this is all possible because of efforts at the regulator level, efforts at the distributor and advisor level, and also the manufacturers, all the mutual funds put together, who have really created a fantastic set of performance.
So 1 lakh to 2 lakh crores happens in the next 3 years?
I mean, I wouldn't be surprised. We will be in a position to achieve that number. It can happen.
AUM is a combination of money being put and also the market factor, right?
Absolutely. And it can even happen faster if, more and more Indians realize the power of compounding. Their savings pattern change from physical savings to financial savings. I mean, for example, if we see the Provident Fund, I mean, they've started investing in equity now. Globally, when we see 401k plans, they are dominated by equity. Here, we are still tasting the water. Clearly, new pension scheme has been a fantastic move, which allows a far better return than Provident Fund. So if we unlock that corpus of savings, which is stuck into the fixed income or traditional investment towards mutual fund, I think this growth can even be faster.
Nilesh, it's great to hear about the money and the kind of numbers that are coming through. But is there a bit of a problem of plenty also that fund managers are now facing? I mean, looking at valuations, looking at the sort of ideas we have in the market, and we keep talking about limited ideas. And again, the money chasing the same set of stocks. Is that a bit of an issue right now?
Undoubtedly, there are challenges. When Tendulkar started playing at 20 years of age, he would have one style of betting. At 30, he improved. At 40, he would have changed it. So we also have to grow with the size, and we also have to adopt with the larger size. But if I look at just from a top-down point of view, today Indian mutual funds will be roughly about 6% of market cap. FIIs are at 25% of market cap. Most of the FIIs, barring few exceptions, would have underperformed mutual funds. So definitely I have to keep my performance track record. But if those FIIs can still deliver performance at 24% of India's market cap, presumably at 6% market cap, I have some more room to go before I have to worry about my size.
I was at this MP summit, Nilesh, last week, and I was having a discussion with S. Naren and Prashant Jain and a couple of others. I think the 4.5 to 5% of India's market cap, you're saying it's closer to 6%. The problem is, do we have enough free float now for mutual funds to capitalize? Or will we have to bank on taking some ownership back from FIIs? Or do we need some kind of structured products now where, you can take some ownership, where you can take more than 100% ownership of listed stocks?
I really wish and pray that the FII start selling Indian equity and we will be able to buy it at cheaper price. But I don't think so FIIs will be that kind. They are unlikely to let go a train which is running at 15-16% compounded per annum for the last so many years. They are unlikely to let go a share in an economy which is likely to become third largest economy over the next couple of years. So I don't expect FIIs to be this charitable that they will give us easy entry point. So we'll have to go to other avenues for making investment. Those avenues will be exit by private equity funds as their funds come to an end. Those exits will be need for infrastructure investment by Indian entrepreneurs, including government. Those sellings will be done by government, who will be looking to raise resources through divestment. Those exits will be through new areas which is getting listed, like the insurance. Someday mutual funds will get listed. You'll have hospitals and so many services which will get listed. So my ability to pick up stocks will be more from divestment by government, and by private equity funds, and the newer sectors
that also explains the
listing.
kind of interest we are seeing in a lot of new IPOs, Nilesh.
Absolutely. I mean, we have seen new IPOs getting listed at a reasonable premium or reasonably high valuation, as if they have already put in, 10, 15 years
Yes.
of track record in performance.
Yes.
So clearly.
But I mean, from what you're saying, there is ample ammunition now with domestic funds to absorb FII selling as and when it happens, or if it continues happening the way it has been. That's been a trend now. It's almost an accepted norm.
I mean, clearly, there was always a dream as Indian mutual fund manager that one day I will receive the same respect as Agora is getting. And today, it's fair to say that we get the same treatment. In the IPOs since 2014, Indian mutual fund and Indian financial institutions have put in more money than FII. Today, it's no longer necessary to sell your IPO by visiting Singapore, Hong Kong, London, and New York. You can actually achieve it by just visiting Bandra Kurla Complex, Lower Parel, Nariman Point, and Chennai. So it's a great sense of achievement in that sense. But more importantly, the size of AUM doesn't matter as long as we don't have satisfied customers.
Yeah.
And what is comfortable today is that, when you go out, some elderly person blesses you saying that, Nilesh, your funds are doing well. I mean, that gives you immense satisfaction. 1 lakh crore, 2 lakh crore, who cares? But that blessings which we get, I think that's beyond numbers.
Yeah, we've got some smart fund managers as well, Nilesh. But you know what? With great power comes great responsibility,
Absolutely.
right? The market is not cheap, and there's this habit of retail investors. This time it's not been the case, by the way, of jumping in at the top. And do you get a sense that it's risky to maybe put a lot of money in the market right now, even via the mutual fund route? Or do you think that's still the way to go?
So undoubtedly, one should take into consideration the risk return profile, and if you are overweight equity or if you are leveraged equity, this is the time to book profit in direct equity as well as in equity mutual funds. And I just want to point, Anuj, one thing. In 2003, we were all riding on huge performance in fixed income fund. 97 to 2003, our fixed income funds delivered better return than most equity funds. And people were throwing, money at us. And all the fixed income fund managers put together gave a unanimous call to the investors that it's time to exit fixed income funds in favor of equity, in favor of liquid funds. And almost 90% of fixed income corpus came down over a very short period of time. I don't think so there is any parallel to this in the entire history of world mutual fund, where fund managers went out to, derail their product, to take investors out of their product. I think what we did in 2003, a lot of these people are still active in mutual fund industry. And if a time comes in equity market where we'll have to take a call to the investors that it is so expensive and it is so bubble and you should be taking your redemption out, we will not hesitate to give that call.
That's really reassuring, and that sort of speaks volumes about obviously the character and the sensitivity with which, of course, managers like you are approaching the business. But, let's also talk about the here and now, this market today, and as things stand. If you were to put in fresh money, where would that money go right now?
So we are essentially picking up a couple of themes across the market capitalization. The one theme is, in absence of private investment, whichever area government is spending money, those businesses are getting volumes as well as growth. So railway construction, road construction, defense, social infrastructure, urban infrastructure, these are the sectors where government is spending money and we are seeing volume growth over there. The second big theme which is being played out is shift of physical savings to financial savings, where people like you have contributed immensely in educating investors. And now we are riding that curve. So right from banks to NBFCs to mutual funds to insurance companies to broking companies to financial intermediaries, we are seeing this trend. The third thing which we are picking up is the shift of unorganized sector to organized sector courtesy GST introduction. Of course, it's going to have short-term pain, but longer term there will be significant benefits. So these are a couple of themes on which we are weaving our portfolios.
But I'm very tempted to ask you a follow-up on that. The shift from unorganized to organized. Now, there's been a huge run on stocks because of this, whether it is certain apparel companies, whether it is logistics stocks, the entire gamut, whether it's tile companies, etc., building products, just because of the GST advantage. Is there more to go, or is it getting a bit excessive now?
So I would like to quote one example of a private sector bank which is attributed to one of the smartest investor in Indian equity market. Radhakishan Damani ji was a big owner of HDFC Bank when HDFC Bank got listed. And he was obviously buying it at very, very expensive prices. And someone told him that, why are you buying this stock? It is so expensive. Why not buy some other stock? And he said, Dekh bhai, dharavi hota hai, pedder road hota hai. So yes, what you are buying today might look expensive, but we are underestimating the ride or the trend which is carrying it. I mean, when you invest with a trend in a successful entrepreneur, the kind of return it can give, irrespective of what price you have bought, is amazing. I mean, just look at, we all started moving from watching a movie in a dabba theater to multiplex. The price which we were paying for the entire family's excursion to dabba theater is now the price of popcorn in multiplex. Now, if you could ride that wave, you have seen what happens to multiplex theatres prices.
Okay, couldn't afford Pedder Road 10 years back. Definitely cannot afford now. But Nilesh, thanks a lot for joining us. As they say, the best time to start an SIP was 25 years back. The next best time is?
Today.
Today. So that's the call, of course, from Nilesh Shah of Kotak Mutual Fund. 1 lakh crores asset under management. Congratulations. And we